Welcome to The Explainer. Right now, every investor is staring down a massive choice. Do you bet on the incredible, world-changing future of AI, or do you stick with the proven, quiet wisdom of old-school value investing? We're going to break down this huge debate for 2026. Okay, let's just dive right in. On one side, you have this unstoppable force of artificial intelligence that feels like it's changing everything. And on the other, you have the timeless, almost comforting appeal of value investing. It's a real clash of ideas, and we're going to unpack both sides of the argument. So, first things first, let's set the stage. To really get what's happening, you have to picture the market being pulled in two totally different directions. This isn't just about stocks going up or down. It's about two powerful, competing stories about where we're all headed.
What we're seeing is this massive tug of war. You've got the promise of exponential, revolutionary growth from tech, pitted against the safety and security of companies that have been around forever, weathering every storm.
All right, let's tackle the bull case for AI first. And the story here, really, it all kicks off with one thing. Just a staggering, mind-boggling amount of money pouring into the space. I mean, just look at this number, almost $400 billion. That's the capital spending from just the five biggest tech giants. And get this, that's a 150% jump in only 3 years. That's not just an investment, that's an all-in bet that AI is, without a doubt, the future. And let's be clear, this chart shows it's not some temporary spike. It's a rocket ship. The projections just keep accelerating, pushing well past $500 billion a year by 2026. What we're watching is a multi-year megatrend as these companies build the fundamental infrastructure, the digital highways, for a world powered by AI. Of course, when you see a chart like that, your mind immediately goes to one thing, the dot-com crash. But proponents like BlackRock here are arguing that this time is different. Why? Because unlike the bubble back in 2000, this rally is being driven by companies with actual massive earnings from real things, like cloud computing, that can justify these higher prices. And here's the crucial point. This isn't just some far-off futuristic dream. It's delivering results today. You've got major corporations, JP Morgan, Citigroup, already reporting tangible benefits, saving thousands of hours and generating billions in value. The payoff isn't coming, it's already here. But you know how it goes. For every action, there's an equal and opposite reaction. And the other big argument in the market is that this intense, single-minded focus on AI has created a golden opportunity in all the places nobody is looking. The thinking here is that this frantic chase for the next big AI stock has created this huge blind spot. Investors are so focused on tech that they're completely ignoring solid, reliable companies that are now, frankly, deeply undervalued. Now, to get this strategy, you need to know about a very special group of companies called the Dividend Aristocrats. And this isn't just a fancy name. Think of it as a badge of honor. It's for companies that have proven their financial strength by increasing their dividends every single year for at least 25 years straight, through recessions, market crashes, you name it. So the game plan is refreshingly simple. Find these amazing businesses that just gush cash, that literally pay you to own them through dividends, and that are basically on the discount rack because the market is distracted by the shiny new toy. These two energy giants are perfect examples. They don't gamble on oil prices, they just own the pipelines. They're like toll takers on a highway. They get paid based on the volume that flows through. It's a steady, predictable business. And when you look at those track records, almost 3 decades of dividend increases, well, that tells you everything you need to know about how reliable that model is. And this strategy goes way beyond energy. I mean, look at these household names. PepsiCo gets dinged because of fears about weight loss drugs. Hormel struggles a bit with inflation. A value investor sees these as short-term headaches for legendary companies that have more than a half-century track record of rewarding their shareholders. But wait, this debate isn't just a two-horse race between AI and value. There's a third, really compelling option that's gaining a lot of steam. In this chart right here is the whole argument in a nutshell. While all eyes are on the US and its incredible AI boom, the data actually suggests the real earnings growth is going to happen somewhere else. I mean, just look at the projections for emerging markets and Europe. They're poised to outpace the US. And what's so interesting is that each of these regions has its own completely independent growth story. You've got Europe finally showing signs of life. Emerging markets are getting a boost from interest rate cuts. Japan is going through this massive corporate makeover. The key idea here is that their success isn't tied to what happens with AI in Silicon Valley. They're playing their own game. Okay, so, wow, we have three very different, very powerful arguments on the table. How do we pull this all together and make sense of it? It really just boils down to a classic trade-off, doesn't it? Are you betting on revolutionary technology, hoping for that explosive growth, but taking on the risk of high valuations? Or are you betting that the market has overreacted, aiming for stability and income, but risking missing out on that next big thing? Or maybe you're betting on the rest of the world to decouple, which gives you great diversification but comes with its own unique risks. And that's the key takeaway, really. There's no single right answer. The market isn't one big thing. It's a dynamic battlefield where these competing ideas about the future are constantly fighting it out. What you believe about tomorrow is what will shape where you see opportunity today. So understanding these arguments isn't just about being a better informed observer. It's about equipping yourself to ask better questions about your own perspective and your own strategy. So the question is, growth, value, or global? How will you see the market? Thanks for joining this explainer.